Hello, everybody. This is the third edition of what's happening in the housing and lending market during the coronavirus outbreak. So today I have back Mina. She's going to be able to go over some of the lending things, and then
Hi,
I'll be
everybody.
going over some of the real estate side as well. So today we're kind of covering three main topics. So first one, we covered it a little bit in the last one, but just going over again how this recession is shaping up to be completely different than the last one. Because there has been some confusion out there in the market. So we just wanted to clarify some things. And then second, Mina's going to be going over what's happened in the last couple of weeks in the mortgage market, any changes that have been made, so you can be aware of that. And then lastly, we'll go over market updates of what's going around in Orange County. So supply, demand, and what's going on and where we think it's going from there. So with that, we're going to get started. So first, we're going to cover a little bit why this recession currently happening because of the coronavirus is completely different than what's happened before. So I'm going to bring up a slide really quickly. I just want to show you one of the main factors looking at home sales is going to be appreciation. So before the last Great Recession you had appreciation that was off the charts. So basically unrealistic appreciation that was happening at 8% or above, pretty much almost the entire time leading up to right before it happened. And then as it happened, you're looking at 12%, 11%. So there was a lot of appreciation happening that shouldn't have happened in the market and basically inflated the rates of homes. And this is one of the reasons that we got into trouble with that. Now, if you contrast that to what's been happening over the last couple of years here, appreciation's at a much more normal rate. So we're looking at anywhere from about 4 to 6% appreciation, which is much more sustainable. And it's not something where homes are being overvalued and we're going to hit a bubble again like we did the last time. And so the second thing I want to bring up relating to the last recession we had compared to this one is how hard it was to be able to get some type of mortgage loan. So before this happened, one of the reasons why we had this crash was because in the mortgage market, loans were going out were just based off of stated income. They weren't doing a lot of documentation. And because of that, it was very easy to get a loan, where currently, if you look at the chart here, and basically ever since the whole crash happened and all the new regulations were put into place, it's been much harder to get a loan. So over the last 10, 12 years, home buyers that are purchasing homes are actually able to afford them, make the payments. And because of this, appreciation has been happening in these houses over the last couple of years, and we're not having as many foreclosures or even any issue with foreclosures because everybody that's being approved for loans are a lot more qualified than they were before. And then two other things I want to bring up is this is the home equity cash out. So again, we went over this last time, but I just want to bring it up again because it is important. So again, before the last Great Recession we had, a lot of people are taking out home equity lines of credit to buy things. They saw appreciation going up every year, so they thought it was no problem taking out more and more credit out of their house and buying things either they didn't need or investing in other things. And this led to a lot of homes without a lot of appreciation happening, as well as any kind of equity built into the home. So if their housing prices went down 5%, they were going underwater. Whereas now, if you look at the amount of people taking any kind of money out of their house, it's significantly gone down. So that means right now there's a lot more equity built up in people's homes than there was before. And so even if someone takes a 5% hit for some reason, if something happened where prices were to drop, you're not looking at foreclosures. You're looking at people still having equity in their home and being able to sell it and sell it for a profit. And this is the reason why we're not going to have that giant foreclosure issue that we had last time, which a lot of people are worried about.
And then also, if I can add on to that really quickly too, when it comes to equity in the homes, this is super important, I guess, factor when it comes to everything right now, just because of the fact that back then, because of that unnatural appreciation rates we were seeing, a lot of people were treating homes as if they were like stocks and trying to flip them in a way. And so buying them and then trying to sell them right away. But homes don't necessarily work like that. But that's why we knew that as of, looking at the data with that chart, if the appreciation rates are that unnatural, there's some kind of artificial factor that's impacting the appreciation rates to be rising at such an unnatural level. And so by then, basically, if all these people are taking out cash and everyone's super optimistic about the market, that's why we're seeing we saw the upside down when it came to a lot of people losing their homes back then. But right now, even if your home value were to drop a little bit from the time you purchased it, keep in mind, if you're in the 30-year fixed rate mortgage, your payments are still fixed. And with the documentation requirements too, like Josh mentioned, fortunately, right now, if you are telling us that you're making a certain amount of income, we need to make sure we document it with your taxes and all those different items. And back then, nothing had to be really documented, and people joke around saying a dog could get a mortgage at that time. And so things are definitely very, very different now.
Got it. Exactly. So the last thing I want to bring up with slides is this last one here too. So this is something that's important because a lot of people don't realize how much inventory was on the market right before the last Great Recession. So if you look at this here, it kind of shows you what the basically inventory level was right before, and that was around 2008. So you can see that we were heavily into a buyer's market. So we have thousands and thousands and thousands of more homes on the market in 2008 than we currently do now. And because of the inventory being so low, it's keeping the market very stable. So before, when homes were hitting the market so fast that the demand wasn't really there, it was basically forcing these homes to be depreciated and selling for a lower cost. Whereas today, because we're still in a seller's market in a lot of the markets in Orange County, the homes are still either appreciating or remaining solid and not dropping dramatically like you saw the last time. So these are just a few things that are kind of showing us using data that this is nothing like the last recession. So a lot of buyers are out there kind of waiting for home prices to crash 10, 15% or more like they did last time. And the data is completely different than it was when we had the Great Recession. That's something that I just want to keep bringing up because a lot of buyers are kind of waiting for that to hit. Now, that could, of course, change if we have this lockdown and it ends up lasting June, July, August, and continues to go, or we have a secondary lockdown, which some experts are starting to talk about. Normal, the flu season comes around November. If that becomes an issue and we have to lock down the nation again, then you might start seeing a little bit of depreciation. But even then, because the fundamentals are so solid in the market right now in terms of people having that equity built up into their house, it would take a lot more than before to be able to start seeing home prices fall any significant amount. So that's something, again, that I just want to bring up because that's one of the biggest questions I've seen from buyers lately is how much are the home prices going to fall? And right now, especially in Southern California, Orange County specifically, in most price ranges, especially under $1 million, we're actually starting to see appreciation start to pick back up a little bit again. And so unless something dramatic happens, it's going to be the way that we're going to be seeing going through the future. So again, we don't see any massive amount of depreciation happening over the next couple of months unless something dramatic changes. So again, that's what I just want to go over that. The next part I want to let Mina kind of talk about, and that's basically anything that's happened over the last few weeks since we last had one of these in the mortgage market and how that's impacting things in terms of getting loans, forbearance issues. That's been a big thing in the media lately. So I want to have her go over that as well. So I will let her take it away.
Yeah, thank you. And then honestly, Josh, yeah, big shout out to you for keeping everybody updated, because I think now with all the different news articles coming out, the number one thing I think everyone just needs to focus on are the facts and data. And so basically with April for mortgage updates, and I'm sure you've heard that there's been a lot of different mortgage updates throughout the entire month of March and April, ever since everything started kind of, climaxing with the pandemic. But today I'm going to be focusing on just a few different topics. The first being the forbearance topic. Secondly, how the FHFA, and then for those of you who don't know, the FHFA are the governing bodies of Fannie Mae, Freddie Mac conventional loans. And then also lastly, any kind of dispel some guideline restriction rumors that I think a lot of buyers have currently in the marketplace. But when it comes to the forbearance, I guess a few key reminders for anyone who's currently, owning a home and are thinking about that forbearance option. I did want to remind everyone that for the forbearance term, the 6 months that you are eligible to potentially, defer or not have to make your mortgage payments during that time. Yes, there's no penalties, no additional fees incurred, but keep in mind you are still going to have to repay back whatever amount of months you missed. So I think some people think that it's just a complete forgiveness program, but that's not the case. And also, depending on the program and who owns your loan, it may be a little bit different the way the repayments might be set up. And so what I recommend is just contacting your mortgage servicer, which is the number located on your mortgage statement. If you are in a position where, you really can't make those payments, then it's definitely going to be, really helpful for not hurting your credit and not incurring any additional penalties. But I just want to make sure everyone's aware that repayment will be required. And then secondly, in terms of the forbearance and the chart that Josh was sharing, if we can pull up one more time. Thank you.
No problem.
Thank you. And so with the forbearance, the reason why this impacts I guess, potential buyers too is just because with forbearance and all the people not making their mortgage payments, I made a quick video, which I'll link to later on in maybe the comment section. But bottom line, when forbearance, families aren't making their mortgage payment for a certain amount of time, and you have that agreement with a servicing company. But what people don't realize is the servicing company still needs to make sure that they pay the investors on the back end, because they're kind of the middlemen. They'll collect the payments from you. And then keep in mind, all mortgages are tied to a mortgage bond that's sold in, including in mutual funds, 401ks, etc. And so the reason why you might have been hearing liquidity problems a lot in the mortgage industry is due to this fact. And so with the forbearance increasing and the servicing companies constantly having to advance these payments and pay the investors who own these mortgages on the back end, it's going to impact the entire liquidity of the mortgage system. And so with that, the reason why it correlates into even the guideline updates is because it's reducing, I guess, or not reducing, but it's actually increasing the risk of lending in general at the moment. And so that's why we're seeing a lot of the restrictions being added and guidelines being changed. But one thing I will kind of, in addition to that, mention too, is that not every loan is being impacted as much as others. Like, for example, jumbo loans and government loans have had more updates rather than conventional Fannie and Freddie. And so I wanted to kind of let everybody know of the fact that it doesn't mean that these guideline changes will prevent you from qualifying now. And so depending on your situation, what mortgage program would work best for you and your family, of course, maybe certain guideline changes may have impacted you, but I just want to make sure that I emphasize the importance of really reaching out to Josh, to me, to people who could provide, again, just some information, facts, and clarity on where exactly you stand. Because you may not have been impacted at all by these changes, but then I think right now we have to keep in mind too that the media sells, unfortunately, bad news and negative headlines. And so a lot of the news articles are kind of being presented in a way where it seems like, it's doom and gloom. No one's going to qualify anymore. Banks don't want to lend money, when that's not the case at all. And actually, like Josh mentioned, buyer purchase applications have gone up in the past week and a half or so. And so that's really pointing to a lot more people entering back into the market, and also showing that these guideline changes are not completely preventing people from qualifying. And so, yeah, just make sure you reach out, get your facts straight. And that's kind of what I wanted to mention with the guideline portion of it. But also with the FHFA, the good news is they are actually kind of taking action to hopefully help the mortgage industry kind of stabilize. And so with the liquidity problem, the issue was servicing companies having to front these payments to the investors when they're not collecting payments anymore on these forbearance loans. And so now the FHFA are limiting the amount of months they have to advance to 4 months, whereas before it could have been 6 months, a year, and that would have caused a really big problem. And so that's actually good news. I mean, it's not the biggest and best news. We would like to see more of those changes being implemented, but it is definitely a start. And so I think as we continue to move along the month of May, we'll probably see more help being announced, and of course the guidelines kind of restrictions being lifted, but everything is temporary. I mean, we're not in a normal market right now just because we're not in a normal world right now. I mean, yeah, literally I'm in my home office and I went on Amazon and bought a sign that says home, and I don't know why. It's literally just because I'm home. That's my COVID brain talking currently. But yeah, so once everything kind of passes, I am confident that, these restrictions will be lifted and we will get back to a lot of the normal programs that were available. But it's just the timeline of things. We just don't know when.
Yeah, I mean, it's definitely, I'm starting to see a lot of the government step in, especially on that secondary mortgage market, and kind of try to stabilize things, because that was one of the biggest issues we talked about before, was that all of these servicing companies just don't have unlimited amount of cash to be able to throw out and keep this going. So I'm glad to start.
And no one could have prepared that much capital for this. I mean, no one could have predicted a pandemic. In the beginning, I still think back to, 5, 4, 3, 2, 1, I'm like a new decade, but I never expected a pandemic.
Yeah. Yep, exactly. It's been insane. Okay, perfect. Well, thank you for the update on that, and that's a lot of good info. So I want to talk about the supply and demand in general. So, and especially actually in Orange County, one of the things I've been seeing over the last week and a half is a lot of data out there that's starting to show that buyers are now starting to enter the market again. So in Orange County specifically, demand actually bottomed out and started to, last week, actually, it went to zero in terms of the graphs. So we're looking at graphs watching demand over the last 4 or 5 weeks, down, 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 down. And last week, we finally hit the bottom of that curve. went to zero, and then over the last 7 days or so, we're starting to climb back up in demand. So it looks like, based on what the data is showing, the demand has bottomed out and is now starting to go back up. So that's a great sign for any sellers out there, because demand should, hopefully, as long as nothing crazy happens over the next couple months, start to continue to climb as we get farther and farther into the summer market. Zillow just released something showing that their actual search, people that are going to their site and searching right now, has actually exceeded last year. So there's a lot of pent up buyers sitting there on their computers at home waiting to purchase homes. And we're starting to see that data that shows, okay, they've been waiting, and they just don't want to wait any longer and are finally starting to get into the market. Another thing that I just saw yesterday was the actual amount of mortgage loan applications rose last week by 12%. So that's something that, again, has been kind of going down over the last couple of weeks, but is now starting to go back up. So again, just one more indication that buyers are starting to enter the market again. And then lastly, to also support that, again, I like to use data. So another thing that I want to show is, this is something that basically shows that this is all of the United States, not specifically to Orange County, but this basically shows the amount of showings that are happening in homes. So blue line, that was last year, orange line, that's this year. And as you see, towards the beginning, mid-April, it kind of bottomed out in terms of the amount of people that are getting showings on their home. And ever since then, it's starting to go back up again. So the interest is there, and the interest is climbing. So that's great news for anybody that's looking to sell their home soon, because signs are starting to appear that it looks like everything's kind of thawing out a little bit, as some of these restrictions are hopefully going to start being lifted in the next 4 to 6 weeks. Not getting back to normal, of course, but slowly allowing people to kind of get out of their house and start doing more of the normal things, like as much as they can, staying safe. So that's just one thing I want to show you. And then in terms of let's pop this other graph up real quick. So this is the expected market time. So this is kind of showing you the demand basically right now. So this is Orange County specifically. And if you look, anything in the green is basically still a seller's market. So in Orange County right now, anything under $1 million is still technically considered a seller's market. Basically, that means anything that's selling in less than 90 days or going into escrow in less than 90 days is considered a seller's market. So right now, especially in that $500,000 to $750,000 range, we're still in a good seller's market right now. Once you go above that $1 million range, then things get a little bit more tricky after that. So once you get up to that 1.2, then you're starting at looking at, or getting closer into a buyer's market. And I bring that up because right now you're going to start seeing a lot of things in the news coming up saying that, hey, it looks like homes are depreciating over across the board. Yes, if you're looking at just the general average, that could be true. But the reason those numbers are kind of skewed is because a lot of this depreciation that might be happening over the next couple of weeks is going to be in that high price point range. So especially in Orange County, again, and this is actually all of Southern California, but especially in Orange County, once you get above $1 million, that's where you might start seeing depreciation, because people are having to keep their homes on the market for months and months and months. And the inventory is just so much higher than what the demand is right now. So a lot of people, when you're purchasing homes above $1 million, a lot of the times the wealth is tied to the stock markets, and we all know how that's been going lately. Obviously, the stock markets are starting to basically start recovering a little bit, and hopefully it continues to go that way. But a lot of those home purchasers are waiting for their portfolios to start showing money back into their accounts again before they're comfortable purchasing these homes. And that's why you see such a dramatic difference between the high end of the market and the low end. So if you're a seller and you need to sell your home right now and you're below that $1 million mark, yes, it might take a little bit longer than it would have if this coronavirus never came about. But we're still technically in a seller's market, or a slight seller's market in these cases, which means that the sellers should get offers on their home. You should be able to sell your house at or a little bit above, in some cases, market value, and continue going through. Now, that doesn't mean that we're back to normal, but it does mean that we have, or I should take that back, I should say we've dropped 50% in terms of transactions. So the market is definitely slowed down, but those 50% of people still looking for homes are going through, and these transactions are still happening. Escrows are still closing, escrows are still opening, and it's not back to usual yet, but it's starting to show signs of getting there. Mina, have you seen anything on your end in terms of applications going up, buyer interest going up? Because on my end, I just had a call with our entire brokerage this morning, and that's kind of what we're seeing is the buyer interest is also going up. So obviously the data is a lagging indicator. We like to be on the front line seeing what's going on a day-to-day basis. So the day-to-day basis is also matching what we're seeing on the data back end, where a lot of people are starting, especially buyers, looking at getting back out there and looking for homes on the market. Are you seeing something similar or different?
Yeah, no, actually, I'm actually seeing a lot of buyers enter the market again because, of course, in the initial quarantine order, we literally, I mean, physically, we were just at home trying to process the news. A lot of families being impacted by everything going on, and people were just kind of scared. But I think as time went on, and if they still have the job security, people started realizing, wait, there actually might be some opportunities. We shouldn't completely turn a blind eye to them. And so, yeah, to answer your question, I've been getting a lot of calls back from people who may have paused their home search for a little bit, but then actually are entering the market again. And I did also want to comment on, I guess, the whole idea of timing the market, because of course that would be the main goal if the clouds can tell us exactly when the perfect time to buy would be. But one recommendation I have for anybody who hasn't bought a home yet and who's currently renting, just trying to figure out when to jump in, I would run the numbers in the scenario of, okay, in the next 3 years or 2 years, even 5 years, whatever the short run or long run plan of, for that home purchase is, which, I guess, options, whether it's not buying currently and waiting 3 years, or whether it's waiting or buying right now and then doing the worst case scenario of the home's depreciating. I think right now, like Josh mentioned, no signs are pointing to an indication of, I guess, the home value is going down by 10, 20, 30, like in no way, shape, or form, or form. But bottom line, if you were to run the scenario, the worst case scenario and the best case scenario, based on the data provided with all the different, I guess, just updates we've been getting in general, see which option would put your family in a better position in that long run. Because even if the home values were to go down by 2%, let's say, in the next year or two, how much would you have spent in renting for the next year or two? And then also think about, I guess, the factor of the tax benefits you would have been missing out on and all those different implications, and run those numbers, or reach out to someone. You could reach out to me and run those numbers so you can make a decision based on actual numbers rather than kind of a speculation, because everybody's throwing out random opinions at the moment. But that's why I like how Josh is presenting data and factual numbers. So it's not opinionated, it's just data and facts.
Got it. Yep, perfect. And then a few more things in terms of the Orange County market. So one of the reasons why our market is still really strong right now for the most part is because at the beginning of the year, the market was so hot. In most cases, by the time March hit, there's a lot of places that already appreciated 5% over the year. So it was actually faster than most people were predicting. Because that was happening, that kind of left us at a point right as it started hitting to have a very strong market to be able to handle this. So when we first started all of these lockdowns, you had demand way up here, supply way down here. So, I mean, it's basic supply and demand curve. What's happened since the coronavirus is the demand has gone down much faster than supply. So right now, demand basically went down. Like I said right before, demand now at this point has bottomed out, and now supply is starting to go back up as well as demand. So over the last almost about 2 weeks, the supply has actually increased about 5%. Well, demand has increased about 2%. So we're starting to see those sellers starting to place their home back on the market as well. Not in giant numbers like before, but we are starting to see those numbers go up in both. And the reason why we're still slightly in a seller's market in a lot of cases is because that demand is still so low. But once that starts picking up, because these low interest rates that have been hanging around all year long and are going to continue to hang around until this is over, most people are predicting at least until next year sometime, we're going to be seeing those start to go back up pretty evenly as they go back up. And to keep the market basically where it is, where you're looking at most homes under $1 million, you're still going to be in a seller's market. Most homes over $1 million will start to hopefully transition out of that slight buyer's market and in more to a balanced market where you usually see it. And that should hopefully happen over the next couple of months. Again, this is assuming that we're not going to have another secondary lockdown later on, and assuming that the lockdown we currently have right now is not going to go past May, June, all the way into July, August type of thing. But if we can get out of this by, let's say, the end of June, those numbers should stay relatively stable and continue to uptick as we slowly open the economy back up. So that's another thing I wanted to point out there, is that those numbers are trending in the right direction. And it looks like they're going to continue to go that way. So that's really all I have in terms of updates for the supply demand of Orange County. But if you have any other questions about it specifically, you can always reach out to me, or Mina, if you have any questions about the loans, what you would qualify for, how much payments would be. She doesn't charge to do that. A lot of people think you talk to a lender and they're going to charge you $100 to look at the numbers. She'll be happy to talk to you, run different scenarios for you, let you know what the best options are. And they'll go, and obviously you're doing Zoom phone calls now. You're not doing it in person or anything like that, but that's really the only difference on there. So that's really all I have. Mina, do you have anything else you want to close out on?
No, not it. I think you basically hit it all. But yeah, like Josh mentioned, if you have any even quick questions, I want to really try to break the barrier of people feeling like they need to be completely ready to go in a day to talk to a lender. But even if you're in the very beginning stages where maybe you even just graduated college and maybe you want to buy a home in the future, I really think you should start talking with a lender about how exactly things are calculated much, much early on. Because when you really think about all the different aspects and details of the lending side of, I guess, how you qualify, you could actually prepare a lot quicker and make a game plan where maybe the 5-year goal turned into a 2-year goal simply just by, asking the right questions and knowing the right information. And so, yeah, I encourage everybody to reach out to any, I guess, mortgage professional you know of or trust. Of course, I'm more than happy to help with that too. But yeah, don't be afraid to, just reach out. Even though you're not completely ready, we'll be happy to at least create a game plan so you know with complete clarity exactly what you need to do in order to qualify in the future.
Perfect. Okay. Well, with that, I think we're pretty much wrapping up. So thanks if you're joining us. If you're getting the last half of this, I'll also be reposting this on my page as well as my Facebook business page, and I'm sure Mina can share it too as well. If you do have any other questions, please feel free to comment below, and both of us will check those out over the next day or so. So that way we can get back to you if you have any specific questions about your situation, and we'll be able to get those answered for you. So thanks again, and have a great day. Bye.
Thank you, everybody.